There are certain things you ought to be thinking about when you start your property business. But unfortunately, what happens is, at that time, you probably aren't thinking about those things, and later on, you realize you should have paid a bit more attention to them. So if you're new to property, this video is pretty much kind of near perfect for you in terms of thinking about those important things, mainly to do with tax. And if you're an existing property investor, you ought to know about these things so you can possibly change your business in light of the information I'm going to share with you. So the first one really is, when you form a company, and here I'm talking about a limited company, when you form a company, thinking about all the different shareholders and thinking about what types of shares to have. So generally speaking, let's say you've got husband and wife. They create a company and they kind of have shares 50-50 each. Now what normally happens is they'll form a brand new company and get ordinary shares. Husband gets one, wife gets one, or they get 2 each, 5 each, or 50 each. Let's just call it 50 each to keep it simple. As time goes on, say in 5 years' time, wife says, I need more money. Husband says, I need less money. So the wife says, I need to take a 50 grand dividend every single year, which she does. Put a wife here. Husband says, I don't need a dividend. The problem is, because they own shares 50-50 each, if she takes 50,000, he's going to take 50,000, and he may be in a very different tax bracket. Therefore, he might be paying extra tax where he doesn't need to, especially because he doesn't need the money. So we have a problem here. How can you potentially overcome that? And you can when you get to here, by the way, but better when you're forming the company, what husband and wife should do is create alphabet shares. So these could be A, B, C, D, all the way to Z. So you can create A class shares, and the husband gets 100% of the A class shares, wife gets B class. Now when you get to this particular stage here, wife says, I need £50,000, so she gets a dividend on the B class shares, and that's the only share class that gets a dividend. Therefore, husband doesn't need to have a dividend because he doesn't own the B class shares. So that's part of the benefit for having different classes of shares. Then you can restrict voting rights, rights on capital, rights on distribution, winding up. So if you've got employees, for example, you might want to give them some shares, but you might not want to give them voting rights, or you might not want to give them rights on exit in terms of getting some funds when you sell the company. Now let's move it one step further. Husband and wife form a company and they've got 2 children, and let's just say they're 18 and 20 years old, just to keep it really simple. So 2 little kids here, well, they're not really kids, they're adults now, but 2 children. Let's just make them smaller here. So what husband and wife do is say, we'll give them some shares as well, and let's say C class and D class, and let's say one goes to son and one daughter, so they've got son and daughter. And what they do is say, we're going to, and let's say they've got some existing or one existing property, but going forward, and let's say they're into flipping properties, but going forward what they're going to do is flip more properties. So what they could do is freeze the value of the existing shares and say all future value goes to C and D class shares, and they can also freeze the value of A and B. So basically these have a fixed value, and let's say they're worth 50,000. Going forward, all the value created goes to C and D shares, and let's say in 5 years time these shares are worth 500 grand. So you can see what's happened here is all the value from the date that these shares were created goes into C and D class shares. So husband and wife now have reduced their exposure for inheritance tax, IHT, and the children get the value of that. Now the consequence of this to some extent, of course, is when the children get their hand on the money, what will they do with the money? That's a question that needs to be asked. If they've got these shares, what voting rights they have, and because they've got that income, will they take over the company so mum and dad don't have anything left over? If they get married and then the marriage doesn't work out, for example, will their spouse have some of this capital, which might be a concern for the parents? So we mean losing income, losing control, and losing some of the assets or the value to a third party are some of the concerns people have. So these are some of the things you should be thinking about before you go into this particular arrangement. But it's quite neat in terms of passing over income and assets and value to your children at some point in the future. Now, if you can do this at the start, it's better because it'll be cheaper for you to set everything up. If you do this once you've got £2-3 million plus value of your estate, it doesn't have to be 2 or 3 million, by the way, it could be £1 million of in your estate, then it's more costly for everything to set up and add new classes and new layers. So if you do it at the start, it's cheaper and better. If you do it later on, it'll cost you more money, but it is achievable. So that's the first thing. Think about alphabet shares, freeze the shares. When should you do them? Do they work for you? And by the way, I don't think the tax tail should wag the dog. It's about thinking about your situation, what you're looking to do. Is it right for you? Just because people out there are talking about it, it doesn't mean you should be doing it. What you need to be looking at your circumstances and think about what feels comfortable and right for you and your family.